market swings, conflicting economic data. Let's take it to call. Kaltbaum Capital Management President Gary Kaltbaum and Belpointe Chief Strategist David Nelson. Gentlemen, the White House Council of Economic Advisors, Kevin Hassett, spoke to Fox Business about the markets. Take a look.
We've got a heck of a lot of momentum going into next year, and small business momentum is something you don't see in markets, right? Because a lot of those firms aren't publicly traded. So anyway, there are a lot of reasons to be optimistic about the upside next year, too. And I think that those risks are better balanced now that the market's moved back towards where it has now.
David, what do you think?
Look, he's trying to paint a rosy picture, and to a large extent, he's correct. Look, markets have kind of disconnected from the U.S. economy, but unfortunately, we don't live in a vacuum. Markets have created overseas, economies overseas are struggling, and ultimately, they are our customers, and that eventually, translates to the top and bottom line here in the United States, especially for large cap U.S. multinationals. But I think for me, the elephant in the room is still the Federal Reserve. It started with them. It started when we started to roll off the balance sheet back in October. The pressure built up all year. And what you saw last week was a policy mistake. And we know it's a policy mistake because they admitted it. Within 24 hours, they sent out New York Fed President Williams out on the networks to kind of walk back the harsh rhetoric. So we still have a long way to go. It was a great 2 days. Let's hope we can add a little bit more before the year end.
8 hikes, a lot of hikes.
8 hikes is a lot of hikes, and it's not just that. This is the end of an experiment. We're rolling off a $4.5 trillion balance sheet, and I think we all understand that the path for normalization is higher, and we have to keep doing that. But I think what the Federal Reserve underestimated is how long it's going to take. Right now, they want to offset this balance sheet in the next 6 years. I think it's going to take a lot longer.
And what do you think?
You talking to me? Okay. Look, I think the Fed has been easy for too long. I think there's been too much blame on them. They're still at 2.25%. That's still easy money. You still have negative rates in Europe and Japan. They're still printing money. So I don't really blame them. All I think that's happened here, and I disagree with Kevin Hassett, every economic statistic around the globe and its expectations have been coming down. We do not have the momentum to the upside. Momentum's more to the downside, and that's what I think you've been seeing in the markets. And for this rally we had, just remember, the Dow dropped 4,268 points in 14 days. So you're going to get a pretty good rally out of that, especially into the end of the year. I'm really worried about what comes in January.
I got to take the other side of that for just a second. I think a lot of this comes from the fact that the Fed operates from an almost Obama-era mindset, that the best that the United States can do is 1.9 or 2%. Anything beyond that, they got to squash it. They saw a hot GDP number this year, hot employment numbers earlier in the year, and I think they went into autopilot, and that's what the markets didn't like. And I grant the fact that we've had easy money for too long. The biggest mistake they made was not starting sooner, but the path is going to have to take a lot longer.
Would you have liked to have seen a hike happen after the first of the year, David?
Another one? No.
No. Would you like to have seen this past hike take place after the first?
No. I don't think we're going to see any hikes before 2020.
Really?
We've seen the last.
And let me just throw it in there. They're not hiking anymore. And if the economic numbers come down, the next move is they're going to lower rates. And I must tell you that last rate hike probably should not have happened. Why? The 10-years at 2.7. They moved it up to 2.25, 2.5. So too close to that. So I think that last part is a mistake. And I think another part of the problem is you're getting too much rosy talk out of the administration as well as the Fed that everything is going to be great in 2019, while a lot of the markets have been saying otherwise. You just don't have industrials and financials and European markets and Asian markets be at new yearly lows and some at 2-year lows, and everything's A-OK. Markets are a very good forecaster of the future, and I think that we're going to see some recessions around the globe. I don't think we're going to see a recession here, but I'm pretty sure we're going to see a major slowdown, probably in the 1.5–2% range, if not worse. I'm keeping fingers crossed that it doesn't get worse than that. But debt and deficits and leverage, that's still out there overhanging things.
You agree?
To a certain extent, yeah, he's correct. I mean, I think for me the problem is really overseas, and it has been for some time. China's obviously in dire straits right now, especially with the trade situation. But I think, the media is almost complicit here. Almost everything you pick up is almost an Armageddon scenario. There was a really good news story the other day coming out from Bloomberg that talked about, China having rolled back, 700 tariffs, 700 that they rolled back on 700 items. Wasn't even mentioned. I didn't see it anywhere in the press at all. And now you've got a government right now that seems half of it is dedicated to making sure absolutely nothing economically good happens over the next 2 years. It's all about the election, and that's unfortunate because it means there's not going to be any legislation, just a lot of litigation.
How do you feel about 3% next year?
3% for what?
Growth?
For Fed growth?
Yeah.
I don't think we can handle it. I think it's going to be a lot lower than that. And Gary's right. The next move might be down. I'm hoping that's not the case. I hope we can maintain this at this point. Look, there's still a lot of things I can point to that are very, very good in this economy. I'm finding no trouble finding companies at reasonable valuations generating a lot of free cash flow. Tons of it. Even some tech companies are generating as much as 10% free cash flow. That's something we didn't see in the last bubble. So there's a lot of things that we can do out there.
Let me just repeat one very important thing. The last year, we have $1.3 trillion of a deficit. In the next year, the first 500 and so billion of our taxpayer dollars are going to interest on the debt. That is a huge problem going forward that not one person in either party is doing anything about. They're basically taunting the economic and market future going forward if somebody doesn't stand up and be a little bit courageous. And unfortunately, the Republicans who had power for 2 years did nothing. And a guy like Paul Ryan, who I was dependent on, guess what? He's gone. So if they don't address that eventually, it's going to come home to pay back and not in a good way.
It's interesting. I find us talking about market conditions here, but yet when I go out in the street, people's income is higher. The average American, his income is higher. Unemployment is good. The retail sector is good. When you go to Main Street America, it doesn't feel this way.
That's the best point that's been made all evening. I'm in my bubble, and I'm looking at my screen, and when I see the markets down, 500-600 points a day, and you walk outside, what are you people? You don't see anything? You're walking around like nothing's happening.
Yes.
And in fact, Main Street is doing very well, and it's likely to do well for some time. But again, these problems that exist overseas, and even the problems that Gary just mentioned just now, they're very important problems. And if we don't do anything about them, eventually it comes home to roost. And Gary's absolutely correct on that.
So we'll catch up with this.
It will catch up if we don't do anything about it.
Gentlemen, a little sad story today. Seeing Sears is down to their last 24 hours with no bidder, and it looks like they're facing liquidation. It's always sad to see an iconic brand like that disappear.
And people forget that, in some ways, Amazon is a modern-day Sears, and Sears was really the Amazon of its time. It was a legend. I remember seeing the old catalogs that my grandmother used to show me, but it's very sad.
Gary, would you have expected that?
I spoke to the past CEO of Walmart yesterday, and very simply, if you don't do anything about your future, it's going to come back to haunt you. And Sears did absolutely nothing to improve themselves over the years. Eddie Lampert, who's been running Sears Kmart, has run it into the ground, and that is a damn shame because it affects the real estate business. It affects all those employees that have lost jobs throughout the years. And guess what? It benefits the ones that are still in business.
A lot of anchors and a lot of malls are going to be impacted by this.
There will be, yeah.